Markets in the red again today. We are joined by Maneesh Deshpande, Managing Director and Head of Equity Derivatives Strategy at Barclays. Thanks very much indeed for coming on the show.
It's a pleasure.
Right now, you say the risk is to the downside for stocks. It's hard to find catalysts to rescue the market, although you note we could get sharp bear market rallies along the way.
Yes.
So tell us, what is the main factor weighing on stocks right now?
So I would say there are really three factors. So number one, you of course have high inflation, and that started even before the start of the year, and that was driven by, partly by supply chain constraints, but also by this enormous fiscal stimulus that the administration did, both in 20 and 21. The second thing, which of course compounded the inflation, was the Russia-Ukraine war. And now that has horrific humanitarian effects, but how it affects financial markets is through the commodity channel, both the energy sector and the food prices, because those regions are the breadbasket of the world. And the third thing I would say, which is weighing on the markets, is really what's happening on China. So China is pursuing a pretty aggressive zero COVID policy, and that's having ramifications not just for the local Chinese economy, but also, again, for the supply chains across the world.
Is there a real risk of us getting into stagflation, aka an economy that's even slowing while relentless price rises continue?
I think that is, all these three things I talked about all sort of, converge into exactly that point, that the risk of a stagflation is high. Because, again, these issues that we are facing with high inflation, what's happening in China with the zero COVID policy or with the Russia-Ukraine war, the central banks can't really do much about that. What they can do is cut demand. And so the risk is that really you could have, a repeat of, God forbid, what happened in the 70s and 80s, where you have, growth slowing, but because inflation is high, the central banks have no option but to keep increasing rates.
You have been studying the 70s, and you say, we think, it was just a hellscape for investors, but you say it's not quite that simple.
Yeah, so actually that was sort of, we actually also had the same bias before we actually crunched the numbers. And interestingly, what you find is that, again, in nominal total return terms, it's not that bad. So, equities over the entire cycle going from 66 to 82, to pick that period, return something like 6.7%. In the long term, from 1920s to now, they have returned 9.9, 10%. So it's not that bad. Even fixed income, their returns were also not that bad during that period compared to the overall long-term returns. The nub, though, is that, of course, inflation has been very low over the long term. So compared to inflation, i.e. real returns, what you could actually do with those returns as an ordinary investor, that was what was horrific. But just in terms of total returns, it was not that bad.
Now, this is, you're talking in very broad terms here, but I understand that in Western OECD countries, and plus Japan, I suppose, the 70s were a time of increasing returns to labor, not capital. Could we be in a situation, we saw obviously anti-union laws passed in the 80s following that. Could we be in a similar situation, though, now with these tight labor markets potentially pushing up wages and compensation?
So, I would. Those are very long-term secular forces, and I don't think you'll have a big sort of shift of that nature in very quickly. Mm-hmm. But certainly, one of the issues is, as you highlighted, the big problem for the U.S. at least is that unemployment is very low. There are 1.9 jobs available for every person who is looking for a job. The participation, i.e., the number of people who are looking for jobs as a fraction of the total, the total population, even that has decreased. So there has been this strange situation where people have just left the labor force. Mm-hmm. So that is certainly creating a lot of problems, and that is a source of the problem. And so yes, so in some sense, the labor's bargaining power is increasing, But I think the big structural shift that you're talking about, I think those are not easily changed.
I have to ask you a question before we go. You have a qualification in theoretical physics from the University of Pennsylvania. What got you into the investing market?
That's a very long story, but it was a mix of personal reasons, and frankly, at that time, there was not that many opportunities to be a theoretical physicist, as a long-term financial career. So, I guess money. That's what I guess in short, one word.
Thank you very much, Maneesh. It was great having you join us.